So as we discussed in the previous video, we use the hybrid annuity as our bond replacement mechanism to avoid that potential bond bubble that we're in right now, but yet to add some stability to the portfolio. But like we mentioned, you know, each of these so-called weapon systems that we're discussing has certain strengths and weaknesses. The weakness of that hybrid annuity is that you can only take 10% a year out of it, and that it can only have a certain limitation of how fast it can grow in a rising market. So if the hybrid annuity is our bond allocation, this would be our stock allocation. And we want this to offset some of the drawbacks that the annuity has. Remember, the annuity you can only take out 10% per year, and it has limited upside potential. This has unlimited upside potential, just limited by however fast the S&P 500 index is growing, which is the broad economy. And we want it to have unlimited liquidity. So we want to be able to take 100% out at any time if you need it. So how does this work? It has, very similarly to the hybrid annuity, it has a bond component, kind of like that would be the insurance company's general portfolio if this were an indexed annuity. And it has the options component, like the call option that you saw earlier on the hybrid annuity. The bond component, which makes up about 90% or so of this portfolio, is a portfolio of laddered high yield bonds. Now, you might be saying, well, I thought he just told us that we want to avoid bond risk, and we do. But so what we do is we minimize the bond risk by keeping the maturities really short. Typically, they're maturing maybe 1 to 2 or 3 years out at the longest. But we can also hedge or protect the downside risk on that bond portfolio by buying a put option. So let's talk about put options briefly for a moment here. So we talked about call options on the annuity. And remember, we used Southwest Airlines as the example. They were able to guarantee a certain price regardless of how high the price of jet fuel went. And so we talked about how we'd use a call option to buy the S&P at a certain guaranteed price regardless of how high it goes. That's what's giving us our upside potential on an annuity. A put option is just the opposite. The easiest way to understand a put option is to think of it as an insurance policy, because that's really what it is. Just like when you buy a home, you would buy a homeowner's insurance policy and you pay a premium, which again, that's the term that's used when you buy a put option. The money you pay for it is not called an investment, it's called premium. So you pay a premium for a put option. That put option has an expiration date, kind of like your homeowner's insurance policy would have a renewal date. And that put option has what's called a strike price, kind of like your homeowner's policy would have a deductible. So if you have damage to your house, if the damage exceeds your deductible, you have the option, hence the term option. So these are put options and call options. So if your damage exceeds your deductible, you would have the option to file a claim. So if your home burned to the ground tonight, you would file a claim and you would put your house onto the insurance company's books. And even though the house has a market value of 0 because it's burned to the ground, they write you a check for the full insured value less the deductible, right? So that's how a homeowner's insurance policy works. And that's exactly how a put option works. You pay a premium that says, regardless of how low the price of this thing drops in the next year or however long the term is, I want to be able to sell it for a certain guaranteed price, kind of like your deductible on your homeowner's policy, and you pay a premium for that. So we're able to mitigate our bond risk by buying a put option against high yield bonds. So we're mitigating our risk in two different ways. We're mitigating our risk by keeping the by keeping the maturity date short. Think of that as kind of giving the companies that we're loaning money to a very short leash to go bankrupt in. And by keeping the maturity date short, it also minimizes our interest rate risk. If the Fed continues to raise interest rates, that does have a little bit of a negative effect on bond values, but if we hold it to maturity, like we would do, and if we don't have defaults, we're guaranteed to earn the yield on that bond from purchase to maturity. And if we don't have defaults, then we get all of our principal back at maturity, which is just 1 to 3 years away. If we do have defaults, we're insuring our default risk by buying that put option against those bonds. Make sense? Then the rest of this you kind of understand from the previous video. We then capture, or we link our upside to the S&P 500 index by buying a call option against the underlying index, against the S&P, which again gives us a right to purchase it at today's price, regardless of how high that price of that index goes. So if the index falls, the only thing we're really out is the price of the option itself, which, as you saw in the hybrid video, the hybrid annuity video, is a very small percentage of the portfolio. So this strategy is designed to capture 70 to 90% of the gain of the S&P 500 index, while minimizing that downside loss to no greater than 8 to 10% in any 12-month period. Last year, for example, in 2017, we saw the S&P 500 index go up about 20%. This strategy, after all fees and expenses, was up about 17% last year. So did exactly what it was supposed to do. In a flat year, like so far as we sit here in April of 2018, we've seen basically a sideways moving market year to date. And as a result, we're capturing 70 to 90% of zero, which is zero. So this strategy is flat year to date this year, but captured about 90% of the gain of the market last year. So that's what we should expect from this. And again, the advantage that this has that the annuity does not have is this is fully liquid. You could take 100% of this out at any time, and it doesn't have that cap of that maximum earning potential of, say, 6%. As I just mentioned, last year this was up about 17. So, but it doesn't have the advantage that the annuity has in that this does have some potential for loss, whereas the annuity has zero potential for loss. So this would be our stock allocation, and the hybrid annuity is our bond allocation. So each of our investment strategies has strengths and weaknesses. The strength of this one is limited loss potential, between 7 or 8 to up to 10%. The weakness is you're not going to capture 100% of the gain. As I said, 70 to 90% of the gain of the market. The other strength, I didn't put it up here, is that it does have unlimited liquidity, whereas the annuity, we said you can only take 10% out per year. So that's kind of the overview of both the pros and the cons of this strategy.